Property investment strategies. So I've been in the industry over a decade ago, and then I left, and then I came back. And what I started to see is there was a whole range of gurus or advisors that were overcomplicating the simple advice around property investment strategies because they wanted to either sell a service or a product. And by doing that, you make things complicated. People think it's all too hard, and they end up just throwing money to solve the problem. Whereas property investing is pretty simple. All the strategies are pretty simple. So in this video, what I wanted to do is go through all the different property investment strategies at a simple level that work in Australia, so that you guys can have a clear understanding of the pros, cons, and my opinion, so that when you make a decision about what property investing strategy you would consider, you know exactly what they are and what would be suitable for you. So let's get into property investing strategies. First things first is I need to cover my backside, and this is not any form of financial advice. This is simply a general discussion on property investing. If you need financial advice which is specific to your particular situation, you need to go and speak to a financial advisor or an accountant, and they will be able to point you in the right direction. And for that reason, by going past this point in the video, you agree to be bound by the terms and conditions which have been linked in the description section of this video, which state that this is not any form of financial advice. Firstly, you might have seen in my beginner's guide to property investing my discussion around the different stages in life for each different property investor. The first type of property investor is the early stage investor. Effectively, under 20, you have low assets, you have low income, but you have the world ahead of you. Now, my 4 bits of advice for this particular investor is build life experience and enjoy yourself. 2 is upskill so you can maximize your income earning potential. Number 3 is to educate yourself financially so you know where or how to build assets once you have them. And finally, it's to sort your stuff out up front so that you can skip having to sort all your other investment things out when you are ready to invest. The next investor is a dink, and this is someone 20 to 30. There's 2 incomes. They generally have a high disposable income. They have a low asset base, but they do have a lot of time. Despite working hard in your career at this point in your life, because you don't have kids, you do have a lot of time. This particular investor would be more suitable to an active investment strategy where they use their high disposable income plus their time to churn into property investment. So active property investment strategies might be suitable. The third stage is the dependent stage. Effectively, you have higher income, but your disposable income's lower because you have some assets that are costing you, and also you have dependents. Your asset base is growing a little bit, and your time is much less. So in this particular stage of your investing career, you should focus on growth because you still have a long-term horizon, but you should focus on passive growth, or what I like to call smart growth, because you don't have a huge amount of time commitment and you have a reduced level of disposable income. The next is peak earnings, and this is effectively when your kids move out. You have a high disposable income, a high income, your asset base is growing, and what you're doing is you're transitioning your growth assets into your income producing assets so you can substitute your high wage for a passive income stream. The final is the legacy stage where you've transitioned from growth assets to cash flow assets, and effectively you are living off a passive income. Anything left over can go to your kids depending on if you like them. Now, I made that joke in the last video as well. And for that reason, you should subscribe to my channel because I reuse jokes. And let's get onto the clickbait part, which is the property investment strategies. As I mentioned in previous videos, there is 2 parent categories of investing. There is active and there is passive. Then under the active and passive phase, there's a growth focus and a cash flow focus. So the first strategy is the active investment stage on the growth side, and this is to do with flipping property. Effectively, it's about trading in property, or basically buying property and then reselling it at a higher rate at a later point in the cycle. A term which is commonly thrown around in US property, which is worth touching on, is wholesaling property, which doesn't work in Australia because there's high transaction costs of purchasing. So when you're trading on property in Australia, like renovating and selling and developing and selling and subdividing and selling, you need to significantly improve the asset's value just to cover the transaction costs. This particular property investment strategy is suitable for the dinks or peak earnings. Now, on the dink side, it's suitable for them because they have a high disposable income, they have time to commit to these strategies, and ultimately they can amplify their asset base or grow their asset base quicker, which they can churn into cash flow at a later stage. The other good thing with dinks and this strategy is they can hold some of the assets and sell some of the assets. Now, on the assets they hold, because they might have completed a development or a subdivision, the actual rental return is higher. So not only are they getting the growth factor of increasing the asset's value, they're also getting better cash flow, which will help them service further debt and grow their portfolio faster. Then I skip a stage and go into peak earnings. The reason why peak earnings earnings would use this active strategy is they can maximize the return on their total portfolio. So as they've accumulated growth assets, they can then start developing or being actively involved in those assets and then selling them off and then using the proceeds of those returns to either pay down debt or invest into other cash flow investments. Remembering most growth assets is a old house on a big block. Now, if you are a peak earner, effectively you might be getting a 1 to 2% net yield on that old house. If you whack on 4 villas, all of a sudden your income return goes from 1 to 2% to 4 to 6%, and then you can sell 2 of those villas to effectively pay the debt down on the other 2, and off the residual, you're effectively doubling your holding cash flow and reducing your debt by using the property development strategy. And the reason why I've skipped active growth investment for the dependent stage is for capital preservation. Let me explain to you this. If you're a dink, you have a high income, you have a lot of time on your hands, and you also have a long investment term. If you make a mistake in the active investment stage, you can ride out the investment cycle and you should be okay. If you are a peak earner, you have a massive asset base and also you have a high income. So if you make a mistake, the actual drawdown over your entire portfolio is quite small. Whereas if you're in that mid stage or the dependent stage, you have a lower disposable income, you have some assets to lose, and you have a shorter investment term, it's better not taking those risks until you have a lot of spare gunpowder at your capacity. The next method is the active property investment cash flow focus. So this is things like Airbnb, short-term letting, room letting, basically anything that you were trying to derive a rental income in excess of the normal rent you would receive on the property if you were just to rent it out. Now, this strategy is great for the dependent stage because you have a lower disposable income, and by increasing your cash flow, this increases your borrowing capacity or free cash flow to make further investments. Ultimately, if, for example, you go from 2 incomes down to 1, that secondary income, provided it's owned the right structure or by the right person, can be offset by the extra cash flow you make from, say, an Airbnb or a room let type of property. Now let's talk about passive property investment. Remembering, you purchase a property, you have growth, you revalue it, you draw out the equity, you buy another property, or you purchase a property, you have rental income, the rental income grows, you save a deposit, and then you purchase another property. Or you could have a combination of both where you get some savings and some equity. That's effectively passive investing. Now, let me run through an example which I've got here on my phone. Effectively, let's just assume you have $150,000 income. You're saving roughly about 15% of your income, and on top of that, 9% is going to superannuation every year, 9.5. The first one is easy. Say, for example, you buy a $400,000 property. Effectively, for a deposit, you would need about 25% of the property's value, 20% for the deposit for the loan, and 5% to cover the costs. This could be reduced down to about 15% or even more if you are willing to pay more LMI. We can assume that this property would generate about a 25% gross income, and 25% of the property's income would go to expenses. So effectively, you're only getting 75% of the 4%. Then the financing costs on the debt component would be around 3% of how much borrowings you have. After all of this, the property would be positive cash flow about $1,500 every year. So you are now saving $15,000 every year plus $1,500 of positive cash flow. This alone would take about 6 years to gain a deposit. Well, that's not the case. Let's just say that the property goes up every year at 6%. This means that in 3 years, the property's expected value is about $475,000. You can often borrow up to 80% of the property's value in terms of a cash out facility. To work this out, it's $475,000 times 80% less the existing loan, which is about $320,000. This leaves you with about $60,000 of drawable equity. $61,000 of drawable equity plus $50,000 of saving means you have about $110,000 of liquid assets, which can go towards the deposit of purchasing the next property. You need to also remember that the property values are probably escalated from $400,000 to $475,000. So to purchase a $475,000 property, you need a 25% deposit. This would be about $120,000. Meaning, after all this, at some point between the 3 to 4 year mark, provided all our assumptions are correct, you would be in a position to buy another property. And from here, what you can then do is draw a net worth chart up and to the right to infinity. Well, that is not the case. Actually, what happens every time you go for a loan is the bank looks at your equity position and also your servicing position. As you purchase more properties, the bank tends to discount your rent and put in a buffer for interest. So each property you buy effectively reduces your servicing power, and at some point you will not service for future debt. There are a range of good things a smart broker can do to help mitigate this, such as separate legal entities and making sure you're not cross-collateralized, but ultimately it comes down to a property investment strategy, and that is when you need to shift. Remembering I said before, property investment is not about one particular strategy. It basically needs to suit your particular situation or stage in life. So what you would need to consider as your servicing starts to get capped out is to focus more and more on cash flow types of property. And because I've spoken so much about growth property, what actually makes a growth property? Well, in this short video, I'll talk about it in a general sense. The first tick box is an established property, because we're focusing on the growth of the asset's value, not growth of the area. And this is a common misconception that most house and land guys will exploit. They'll talk to you about how much the area is growing and how many properties are growing in there, but they're not talking about the price appreciation of the property. Established properties generally appreciate faster than house and land packages. Then we look at land value, and you want to buy as much land value as possible because land appreciates and buildings depreciate. Effectively, tenants pay for the improvements, and this is why newer properties have higher cash flows, whereas older properties with less building value or improvement value get lower rents and have a lower yield, but they get better growth because they have more underlying land value. Then we want to find an affordable property, and when I say affordable, it's different to cheap. Cheap is cheap. Affordable is getting as close to the city as possible in an area that's gentrifying, but not going for the cheapest area in a city. Then you want to be able to polish it. Effectively, you want something you can tidy up, renovate, subdivide, or do something where you're driving the growth of the property's value. Now, people will ask, why do I always favor growth first over cash flow first? Well, let me explain to you why. Firstly, I call this smart growth. Effectively, you're using Australia's tax law to your advantage in accumulating assets. And for other smart growth things to do, you should subscribe to this channel. So go there and, click the subscribe button, because this way you will grow your assets a lot quicker. So let me talk to you about the tax situation. Effectively, when you earn an income, you pay tax at the full marginal tax rate. When you hold an asset and you sell it, you pay tax based on a capital gains tax basis. Now, that capital gains tax is based on your marginal tax rate. But if you hold the asset over 12 months, you get a 50% discount. So when you buy a growth asset and it's negatively geared, the deductions you're getting and offsetting against your wage are based on your full marginal tax rate. Then you draw equity on that growth asset, and that's not taxed because you can draw out the debt for free in a kind of like a tax-free environment. But when you sell the asset, you are effectively only paying 50% capital gains tax based on your marginal tax rate. So your deductions going in are at $1, and the tax you pay on the back end is only 50 cents. So this is why the tax situation works to your favor. And the other good factor is growth upon growth upon growth. Effectively, if you purchase an asset and it continues to grow year on year on year, and it's a high growth asset, that will exponentially increase and accentuate the longer you hold that property investment. The next is passive cash flow investment, and this is where you focus on the rental return of a property investment. For cash flow investments, the measurement commonly used is a yield, and the yield is basically the income divided by the asset's value or the purchase price. For residential investments in metro areas, a good gross yield is around 6%. In regional areas, it might be 7 to 8%. Noting this is a gross yield, so this is a total income, and this does not take into account deducting your costs of holding the property. In the commercial space, the net yield is often around 7 to 8%. Now, the net yield is your total yield, removing all your holding costs. Common strategies used to get cash flow outside of just buying a high yield investment is granny flats, commercial property, also developing property into new so you get a better rental income, and renovating property to increase the rental income. And finally, who's suitable for this particular strategy? Well, this is often peak earnings to the legacy phase. Ultimately, it's as you are transitioning from growth assets into cash flow assets, you want to be considering higher yields, because effectively, when you're in retirement and you're substituting your wage for a passive income, it's best to be focusing on yield investments because capital appreciation is not as important. So what does a high yield investment look like? Well, firstly, it's often located in cheaper areas further outside of the CBD, because what you're trying to do is minimize the amount of land land value you're paying, and effectively you're trying to maximize the improvements on the land so that tenants are willing to pay a higher rent. So this means it's more than likely a newer property in a cheaper area. So these strategies give you a pretty clear idea of all the different property investment strategies that work in Australia. Now, I know there is a lot more. There's lease options, there's recycling debt, but commonly a lot of these other strategies are basically relying on the core fundamentals, and then they're getting repackaged up into a program or a course or a service and then effectively sold to you at an inflated price so that you can be told to get rich quick. And then when it all falls away, effectively you are no closer to financial freedom or receiving a passive income than where you were before considering the course. But in saying this, there is a way to get rich quick, or should I say quicker. So the first thing you do to get rich quicker is to subscribe to the channel. So click the subscribe button, because if you don't, I won't tell you the ways to get rich quicker. The first tip is to buy well. Now, if you are an active investor, you have all the transaction costs of purchasing property and then selling the property. Whereas if you are a passive investor, you don't have those transaction costs of selling the property. So if you pay $1 more than what an active investor is willing to pay, you are still getting an exceptional deal because they physically can't make it work, and then you get to collect all the upside in buying the property really well. So when you're looking at property investment deals, what you want to do is put your active investor hat on and work out what they need to pay for the property. And if you're a passive investor, you pay effectively $1 more. Now, I don't practically mean $1, but if you're 5 or 10 grand more than what an active investor is willing to pay, you are still buying really well and speeding up your wealth accumulation process. The next thing is renovation, and I'm not talking about getting in a sledgehammer, knocking down walls, getting an interior designer and staging the property. That's not the case. I'm talking about spending 3% of the property's value to improve the property in terms of biggest bang for your buck. This is things like flooring and painting. You want to be aiming to get $3 back in equity for every dollar that you're spending on the property. Moving along, the next thing is subdivision, where effectively you can hold the front house, split the back, and then sell off the back land or sell off the house and use the proceeds to pay down the other. And finally, there is developing, which is good for dinks and people that are in the peak earning capacity of their career, because this has a double whammy effect. Firstly, you increase your cash flow because you have a newer property that's rentable out. Secondly, you increase your property's value because you get the developed margin. And thirdly, you can sell off part of the property to pay down debt, which ultimately increases your free cash flow because you're not carrying as much borrowings. The final strategy is a little bit more passive, and that's focusing on rezoning areas. So this is considering purchasing a property in an area that's single residential that in 2, 3 or 10 years from now would be zoned for 2, 3 or 4, 5 units. Effectively, you'll get the extra uplift on your unimproved land value, which will help drive capital growth. Now you know effectively the stages in investing, you know passive and active investing, you know growth and cash flow investing, and also you know how to fast track these strategies to make sure you accumulate your wealth sooner. So until you determine the next property investment strategy that you would like to conquer, or my next video, best of luck and goodbye.